please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. You're watching Reporter's Diary. On to all the market action of the day. Markets took a pause after 2 consecutive days of rallying to end flat. The Nifty gave up the 10,950 mark, so let's bring those charts up for you. And the Sensex breached its all-time closing high intraday. Broader markets outperformed, but the Bank Nifty ended with cuts of about 90 points. Mid-caps too shed about 100 points, but managed to hold on to the 18,500 mark. Surbhi Upadhyay joins us now. Surbhi, Dalal Street managed to outperform global peers amidst these trade war fears.
A day of consolidation on Dalal Street. A lot of the trade talk worries were back. And while they couldn't exactly drown out the bulls, there was definitely some tempering that was evident. Having said that, one must take on board the fact that India has actually outperformed a lot of the key global markets today. A lot of the Asian markets were down 1.5%, whereas we have ended, at least at the index level, on a flat note. The sort of sore part of trade today was mid-caps were again feeling the heat, particularly stocks which have global exposure. And I'll come to those names in just a minute. The sector of the day definitely was the IT space, the stock of the day being none other than TCS. So let me quickly drill it down to actual names now. The TCS rub-off was felt across the entire IT space, particularly large-cap IT. And names like Infosys, HCL Tech, Wipro, TCS, all of these stocks had a good surge today to contend with. Also batting for the bulls were a couple of other index heavyweights. Reliance Industries, for instance, HUL coming out there and hitting another fresh 52-week high, and some of the private sector banking names like Kotak Mahindra Bank. However, having said that, let me come to the downside of the market now, because a lot of the big banks were also responsible for pulling things on the downside. ICICI Bank, State Bank of India being among them. On the financial side, even HDFC chose to sit out of the upside game today. UPL India continues to face the heat, down another 5% on that stock. And Coal India, concerns about divestment, etc., perhaps playing out. That stock was also fairly weak in today's trading action. Metals, largely speaking, were on the back foot. And that's the point that I was making, that global-facing stocks, global-facing businesses were not definitely the order of the day today. So your Hindalco, SAIL, NALCO, Tata Steel, most of the names were on the downside. In fact, when we come to the losers list on the mid-cap arena, we'll see some of these names shape up. So SAIL, for instance, a stock like Motherson Sumi, which has a considerable global focus, that was also down about 4% as well. Other losers included names like Ramco Cements, some of the mid-cap PSU banks like Bank of India, OBC, etc. were also on the downside. Gaining ground, a lot of consumption names found favor. Jubilant Foodworks hitting a fresh 52-week high, as did Godrej Consumer. And last but not the least, some favorable tariff relief coming in for Adani Power, and that stock surged 18%.
All right, Surbhi, thank you so much for bringing us all the market action. So India, they're absolutely bucking the global trend. But after a cheerful mood at the start of the week, global markets have crashed sharply. The sharp dip in sentiment follows the publication of a list of goods making up $200 billion worth of U.S. imports from China that may be subjected to a 10% tariff. So all of the markets there in the red. So all the Asian benchmark indices ended with sharp cuts. The Shanghai Composite lost nearly 1.8%. The Hang Seng in Hong Kong and the Japanese Nikkei were down over 1% each. And it is a similar picture in Europe, where the German DAX, French CAC and British FTSE are all losing over 1% each, owing to trade war concerns. So clearly, investors around the world began the day rattled by the deepening trade tussle between the United States and China. Overnight, the United States began the process of slapping 10% tariffs on $200 billion worth of imports from China. This is on top of tariffs that were imposed on $34 billion worth of goods just last week. Now, the move marks a significant escalation of the trade war between Washington and Beijing, raising the dangers of a major economic shock. It's not just China, though. Donald Trump has launched a tirade against Germany at the ongoing NATO summit in Brussels, accusing Berlin of being a captive of the Russians. CNBC's Iman Javez is in Brussels tracking that NATO summit. He joins us with the latest on what has transpired so far. Iman.
It's been very fiery here for the beginning of the NATO summit, but also you're talking about those new Chinese tariffs that have been announced by the United States that don't go into effect just yet. Take a look at some of the details here. What we're looking at is 10% tariffs on $200 billion worth of Chinese goods, and that means it's going to undergo a 2-month review with public hearings on August 20th to the 23rd. It's going to target some of those made in China 2025 items. Those are the items that are so important to the Chinese government in terms of the expansion of their advanced advanced technology capability. The United States here striking directly at that aggressive economic expansion initiative by the Chinese. So we'll see what the Chinese reaction is here. But so far, we've seen this tit-for-tat, back and forth tariff escalation between the Chinese and the United States over the past several months. That's bound to have some impact on the markets, as you guys have been talking about this morning. Meanwhile, here in Brussels, the President of the United States coming out very aggressively with some harsh words for Germany in his opening salvo at NATO. Here's what the President said.
If you look at it, Germany is a captive of Russia because they supply. They got rid of their coal plants. They got rid of their nuclear. They're getting so much of the oil and gas from Russia. I think it's something that NATO has to look at. I think it's very inappropriate.
So the president there very critical of Germany coming out swinging in his opening salvo here at NATO. No reaction yet publicly from the German side to those comments, but you can imagine they will provoke some real angst here in Brussels as all the NATO allies look at the president of the United States, who's coming here. His stated goal is to get the NATO allies to spend more on their own defense spending, up to 2% of GDP. Not all of the countries have hit that guideline that they've agreed to. The president wants them to step it up.
Right, Iman. Thank you so much for those details. On to some court action. Then the Supreme Court of India today slammed the centre and the Uttar Pradesh government for their lethargy in taking steps to protect the Taj Mahal. Now, expressing its dissatisfaction, the court said, and I quote, "Either we will shut down the Taj or you demolish or restore it," end quote. The court added that it will conduct daily hearings on the matter from the 31st of this month. It also ordered the formation of a special committee which will look into the source of pollution and will come up with suggestions to tackle the same. Tata Consultancy Services kicked off the IT earnings season with a bang, delivering a beat on all counts. TCS registered a constant currency growth of 4.1% in the first quarter of FY19. This is its highest in the last 15 quarters. Earlier today, Reema Tendulkar caught up with Rajesh Gopinathan, the MD and CEO, as well as NG Subramanian, the COO of TCS, to get a sense of when the street can expect double-digit margin growth. Listen in.
As we had been talking about through the last few quarters, we've been focused on trying to get back to the double-digit trajectory. Still a tad short of that, but we have the momentum, and most importantly, the broad-based growth coming across all segments, especially the turnaround that we're seeing in both BFSI as well as North America, is giving us a lot of confidence that we should be able to get there.
Okay, let's talk about margins then. And I'm quoting what you said, the strong start gives us a greater ability to get to our preferred margin range of 26 to 28%. It's going to happen in FY19. Are you confident about that? X of rupee.
First of all, it's not X of rupee, it's including rupee.
No,
which
I
I
think
said
irrespective of what rupee happens from
that
here
is
on.
true. No, but we don't want to put a timeline on that. I think the important levers are that are we getting growth back into across segments? Is there a broad basing of the digital revenue? All of those are kicking in, but I wouldn't want to put a timeline on when we want to get back there. It's the target band and we're quite confident about getting there.
Digital is now $5 billion of annualized revenues, 25% of a very large book that is TCS. The pace of growth has picked up. See, a year ago it was growing at 30-35%. Now it's growing at 45%. Is it sustainable, and are the contract sizes getting larger and longer tenure?
So the contract sizes are definitely getting larger.
So what is this rough size, average size or range now?
No, Reema, again, we have said this in the past. For us, more and more, digital is now becoming integrated into more complex contracts. So the breakout of it is more in terms of the services that we deliver. But at a contract level, it is not as if it's a digital contract versus a non-digital contract. But the scope of work is significantly increasing, and it is becoming more core of what we're doing. So given that, will the growth momentum at 45%, will it accelerate further and all? It's difficult to say. But last year we grew at 30% plus. Definitely this year also in digital, we should be well on our way to achieve better than 30%. So beyond that, it is, it's at a level that it's very difficult to call.
Your manufacturing and high-tech grew lower than the company average. Any particular issues there?
It's, there are, clearly, if you take the automotive side of it, there are, they're all focused on the autonomous vehicle programs. Then they are figuring out, how they should play out the electric vehicle initiatives. And some of these things have resulted in slowdowns in some of the, let's say, the car manufacturers. Whereas, we see a corresponding investment that's happening on the OEM providers, right?
Okay.
So, I think it's only a question of time before they turn around.
But say automotive manufacturing could remain slow for some time?
Maybe in another quarter or so, we should have better visibility for that.
So far, you've managed to grow without making any acquisitions, which is what makes TCS's growth so special. It's organic. Are you looking at making any acquisitions?
So it's an important one that we have always been, as I said, open to acquisitions. Yeah. But it is important that the turnaround was achieved organically, because it's a validation of our strategy and positions us well and takes away a lot of the negative commentary or the doubts that were expressed. Given where we are and the foundation that we have, we will be open to incremental acquisitions to accelerate this momentum that we see, so which continues to be the focus.